Let's look at your cash sitting in a standard bank account. Whether in Taiwanese dollars or US dollars, right now it is losing purchasing power to inflation. You might want to move that money into a stronger currency to invest. But buying US dollars today means facing spot rates sitting high around 31.58. It feels expensive to make the trade right now. Then your bank offers a 1-month dual currency investment, a DCI, that promises a 12% annualized yield while you wait. Moving money here transitions your capital into a time-locked contract where yields are tied directly to future exchange rate movements. DCIs essentially function as options-based trading strategies. This matrix breaks down the trade-offs. For your idle cash, yield is under 2%. You retain immediate access and FX risk as zero. Now look at the DCI column. You hit that 12% target yield, but liquidity is strictly locked and FX risk increases. That 12% interest is an options premium. The bank pays you this rate because you are legally agreeing to buy a specific currency at a specific future price, regardless of market volatility. This choice rests on whether you value immediate cash access over the chance to secure a subsidized currency conversion. Let's walk through the 30-day life cycle of a standard DCI contract to see how these trade-offs function in practice. This flowchart maps the timeline, starting when you commit your initial capital. This locks your funds away for 30 days without access. In exchange for this illiquidity, you secure a guaranteed 1% monthly premium, representing the 12% annualized yield. Next, you set your strike price. If the current spot rate for Australian dollars is 0.7139, you might set your strike down at 0.7050. By setting a strike below the current market, you are placing an automated limit order. This removes the need to watch the charts or guess the market bottom. However, you are also capping your flexibility. If the market crashes to 0.6900, you are still absolutely legally bound to buy at your original 0.7050 strike price. Entering this contract means trading away your market adaptability for automated trading discipline and a guaranteed yield premium. Once the 30-day term ends, the market dictates which of two absolute outcomes occurs. The flowchart splits into two paths. Scenario A triggers if the Australian dollar hits your 0.7050 strike price. Your capital plus interest converts into Australian dollars. By adding the 1% interest before conversion, your effective cost drops to 0.6980, a clear discount. Keep in mind, at this point, you no longer hold your original US dollars. Scenario B occurs if the market stays flat or moves away from your target, missing your strike price. Here, your original base currency is returned to you in full, along with the 12% annualized yield payout. While you outperformed standard bank deposit rates, you ultimately failed to acquire the specific foreign currency you initially aimed for. The math proves that DCI is a subsidized conversion tool, provided you are comfortable holding whichever currency the market delivers at maturity. The mathematical outcomes only matter if they align with your long-term intent for that idle cash. This quadrant chart plots your need for original cash against your desire for a new currency. We'll start with the top left profile in red. The yield chaser wants the high interest, but needs their original cash back soon for other obligations. Utilizing a DCI introduces currency depreciation risk into what should be a liquid emergency fund. If the market forces a conversion, your capital is no longer in the currency you need. Yield chasers should keep funds in standard fixed deposits or high-yield savings accounts, where principal remains in the base currency. Now look at the strategic allocator. You are already planning to purchase US dollars for stocks or Australian dollars for bonds in the near future. For you, DCI turns a waiting period into a yield-generating mechanism that often results in a heavily subsidized exchange rate. For strategic allocators, this provides a lower acquisition cost than simply buying at the current spot rate. This tool allows your initial currency acquisition to fit smoothly into a much larger, carefully planned financial transition. A DCI serves as a subsidized limit order for those executing a planned currency transition.